Good afternoon for those of you joining us for the first time. My name is Roy Weiler. I'm the Director of Trading Operations for Time Leverage Capital. For anyone who missed our previous webinars, please give us a call at 800-519-9085 and we can send the videos you missed. You can also browse the videos by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based on your level, at your pace, and on your schedule. For an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples we'll discuss today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our short Strangles and Straddles, when to use and how to calculate webinar. Mr. Mueller.
Thank you, Roy. Certainly having some excitement and activity in the markets, and we are going to discuss today a strategy and just briefly review the steps on how one arrives at this strategy. So to go over our principal format, again, everything begins on the Option Ranger software with a very intuitive interface. And essentially, there are multiple interfaces that we have. We have calculators that are, and let me just very briefly take us to the different software for different levels and beginners, advanced, and intermediate. And we basically have a pyramid of learning. We try to figure out where we are along that pyramid. We begin with the basic strategies of stocks and stock options, the real foundations, buying the instrument, buying calls, buying puts, writing calls, writing puts. The same in the futures markets with all of the ticks and calculations figured in. Then you move on to spreads, both in stocks and futures options, depending on where you do your trading. And, you know, they are very similar, so when you learn one, you might as well learn the other. And finally, for the graduates, so to speak, the master combination calculator. The early stages have extra tutorial and informational steps using graphs, charts, and kind of beginner links. So before going much further, if you have any questions, be sure to get to our frequently asked questions section and guide and to our reference materials. And you will see their definitions on option sheets, demo videos, and margin rates. So if you want to go back to basics and definitions, always begin with the basics, and then once you have those basics and inputs in place, we can move step by step to more advanced strategies. Finally, for those of you who like to start by looking at markets rather than prices first, under the Markets tab, we have all the different markets listed, and then subcategories of markets to a good extent. And so you can look at the trading hours on any given market. On one click, you can go to a chart on that market. You have a quick, handy link to some of the other terminology if you want to look at it in the middle. And then compiled over many years, a lot of the fundamental factors that you should consider before you work in any given market. In this particular case, the example is on soybeans. The types of things to look out for, and you know, I think there are always surprises and new things, but some of the constants here, like the CFTC Commitment of Traders reports, the various USDA reports on the grains, as well as some of these other factors at different times of year, should play a part in how you get in, if you get in, and also how you respond to these various news. Many of these are primary sources, so when you can click on that link directly, you are just one step away from the primary source and the primary report. Once you have some sort of a market outlook, whether it's by looking at primary sources or receiving advisory services or newsletters or doing your own analysis, you come to the strategy gallery. And basically our strategy gallery is, let me just open that up, is a place where all the different types of trades appear that you can check out. So let's have a quick look at that. And today we are going to be looking at a strategy in that gallery. This gallery essentially sets up a number of scenarios that consist of two factors in picking a trade. Most people use one factor, which is direction. People think up, and mostly this is what people understand, the market going up, and what to buy and hopefully when to sell it. The confusion begins for everybody when you get to the very next thing, which is very basic, which is how to work with a market going down. There's a fear of being short, there's a fear of doing short strategies, which in part is very well founded because there are risks associated with that type of trading, but are also based in large part on misinformation, and fear often results from lack of knowledge or misinformation. So again, just understanding how to be bearish, the different degrees of risk of being bearish, will help people determine whether or not there's any bearish strategy that can work for them, rather than just hopping on one leg looking for one direction perpetually. And finally, there are also strategies for undecided markets, where you have an outlook that the market will go sideways or will be tame and quiet. That, in part, goes through the next factor, which must be considered when you put on a trade, whether you're just trading the instrument or whether you're using options. Definitely, you have to look at the volatility outlook. And if you haven't seen it, among our demo videos, where you can see some of the introductory videos in case we're a step ahead of where you are, you can see all the terminology. Now we have a discussion of volatility. So in addition of having a sense of whether we believe a market's going to go up, down, or sideways, in order to have a holistic opinion, in order to have a fully relevant opinion to what matters in market action, we have to also come up with a volatility outlook, and volatility can increase. And you can see here it's illustrated with a market that seems to be quiet, and then begins to make some more extreme moves. This is a rise in volatility. As you might expect, let's say if a market is very quiet and all of a sudden there's an anticipation of some news that makes everybody panic in every direction. This may create extreme moves in the market. It would also create an increase in the volatility premium that is in the options, and that's very important to track. Secondly, there's a second scenario, which is volatility falling. And finally, there's volatility undecided. Today's trade that we are going to examine is in the volatility falling categories. Just as earlier this week, we did one in undecided direction. We looked at long premium trades where there's an expectation of rising volatility or increasing panic or premium to come into the market. Today we are going to do the exact opposite, which is still not having a direction, being undecided on direction. So we're not really sure what's going to happen. We think the market's directionally, we have no idea what it's going to do, but there's one thing that we do believe, and that's when this trade is done, that's we believe that volatility is going to fall. And then depending on how much you think the volatility is going to fall, you have a choice of doing a short straddle or a short strangle. For those of you who attended this Tuesday, you're going to see that they are very familiar. As you can see, the trade for a long straddle and a short straddle are very similar looking. In fact, they're the opposite of each other because they're looking for opposite scenarios. The long straddle is looking for the market to break out one way or the other. The short straddle is looking for the market to tighten up in its range and the premiums to go down, volatility go down. And likewise, as you can see, the long strangle is the mirror image of the short strangle. Again, the long strangle is an expectation of rising volatility in some direction, don't know which, whereas a short strangle is the exact opposite if you look at it, which is betting on the opposite, which is that volatility will diminish. These people are on the opposite sides of these trades, so that's how they find counterparties to the transaction. And let's have a quick look at a composition of this trade. Remember, when you go into a strategy gallery and you have your outlook, you don't have your strike prices yet, you don't know quite where to go, but you say, well, I think there's going to be diminishing volatility by a lot in this market, but I don't know which way. And ignorance sometimes is not good, but it's good for somebody to admit what they know and what they don't know and trade accordingly. And then finally, we have a way of, we're going to go straight to the short strangle trade that we discussed. So you can click on it and you get the particulars of the trade. And again, on the same page, you see, and let's go to the right, you see the particulars of the trade, the maximum profit potential. And again, when you see this on a spreadsheet, it's going to make a lot more sense than seeing it on a graph. But as you can see, this is the premium. When you do a short strangle, it's a specialized trade. Obviously, it's volatility. As we discussed, you do when you think the market appears that the market will be calm and trade in a range for a period of time. And that's buy option expiration. Very important, the profit and loss box you should always look at, because in many cases this could just altogether preclude your participation in a trade. So here, when you do a short strangle, you're working for a limited profit. The most you can make, if the market is quiet as you anticipated, was that the two options that you sold, one above the market, the call above the market, and then the short put below the market, would expire worthless, and then you get to keep that premium paid when the market stays in your range between those two strike prices. On the other hand, and this is very important, it comes with short strangles and with short straddles. The margin and loss potential on these trades is unlimited. This is a margin trade. So if the market breaks out in either direction with rising volatility, which is the exact opposite of the opinion when you put this on, which is that the market will not break out in either direction, and with that falling volatility, then you've got a margin trade, and as you will see later on very large, very explosive moves, that margin risk can be pretty significant. One of the reasons this trade is somewhat popular, we see some CTAs and other managers use them, is because it does have the advantage of time decay. Anybody who's bought options probably hates time decay, because that's a big enemy of option buyers, and it is a friend of the option seller, so that time decay is positive for the short strangle strategy. The more time passes, the more time there is that nothing happens or breaks out in either direction. The value of those options that were purchased by the counterparty continue to erode. The time value continues to erode. And if the market expires between those strike prices in that range, the premium that was collected, net of commissions and fees, is the gain on the trade. Again, when you do this trade, in addition to the time decay factor, one of the elements is that if you look at this example where you sell a put at 84, you sell a call at 87, it is clear that the market can't be above 87, where it's hurting the call, and below 84 at the same time. So these are mutually exclusive trades. So even in the event that the market does not expire between the two, if it slightly exceeds one level or the other right at expiration, the cushion of the premium that was collected is still available to mitigate the losses or perhaps turn a small gain, because again, at the very least, if both options don't expire out of the money, one of them could. So it takes a pretty explosive move contrary to the expectations in this particular trade when it's put on, for the market not only to go in one direction, but also to overcome the premium that was collected on the opposite side and on the side which is in trouble. And finally, as you look at the short strangle description, you get a trade description here. There are also additional demo videos from other examples that we did on short strangles and short straddles that you can see in our demo video section, and also how to input the basic trade. So please be sure to use that section and check with your coach or whoever is the developer that's working with you on your program to make sure that you watch the videos that are appropriate to your level. These are very helpful. Most of them we kept under 5 minutes so that you can review them multiple times and practice with your own login to make sure that you got the inputs right. And now, without any further delay, now that we know what we're looking for flattening markets, sideways movement, no excitement, no breakouts. Let's go ahead and pull up some examples. Again, as we've said before, these are illustrations, not trade recommendations. And in many cases, we might show opposite opinions in a particular trade for purposes of illustrating how the trade works, and clearly not because one or the other would be recommended, because many of them are opposite trades. And that's actually look at some things that we looked at previously, since they're already input. So on the 13th, actually interestingly enough 2 weeks ago to the day, we did an example on the S&P, and let's see where that is today. We saved it under short strangles. We wrote there that the expectation was volatility was down. Volatility outlook was for the volatility to go down. Directional outlook was none. And I like to name a tab so we know what's going on. I'll suggest you do the same, and we'll help you with it. I actually put margin on that tab. If anybody here has no risk tolerance for margin, don't need to look at this thing except for educational purposes, because as I indicated and as we can see here, it's a margin trade. So let's go ahead and see where this trade was. And as you see on the 13th, we had a look. As you recall, whenever you input a contract market and it's already saved, the dialog box comes up giving you the tick values and the contract size. And as you know, you can always click here and look at the contract specs, the short-term chart, and the what to watch area with links. As you remember, that was over here. So in this case, you would either click on the complete contract specs or go to markets, go to stock indices if it's an S&P, and then you go to the S&P 500 page. In addition to that, I will just remind you all of the inputs are here. If we forget an input, you'll get a box that will remind you to put it in. In this particular scenario, also if somebody wants to just double check on their terminology, when you input the trade, a box comes up that gives you an explanation of how to input the trade and how it's described. And every dialog box that pops up for you to see right away takes you just one step away from, in this case, from learning more about strike prices, which defines in, at, and out of the money options. And then, of course, you can continue going to the demos or the FAQs for more definitions. And when you click on the premium, automatically you get the definition of premium. If you need to review and you're still in review mode, you go to learn more. If not, all of this is self-explanatory. And in fact, you can even X out these boxes so they don't distract you, and just continue with your examples. So having done all that, let's see what we were looking at on the 13th. This was a large S&P contract. We have the contract specs there. And in case, oh my, no, I shouldn't have erased it. Let me just figure out what they were. You can just go back in there, and you can either go to the markets gallery, and get that, or you can just, let me see. You can go ahead and re-input the item in the dialog box, and immediately your help comes up. We're talking again short strangles. Just a moment. Okay, so we're going to go ahead and input some costs, and then we can go ahead and reset the trade, or remember, if you don't want to go back all the way, you've already got the trade saved over here, and it'll repopulate all your fields right away. So let's see, in this initial trade was a short strangle. We can use it for illustration purposes again. The premium, first you get the dialog box which defines it. You see the word short strangle right there as a reminder. It consists of selling a call and selling a put. The quantity is reviewed, the contract market is reviewed, and the premium is reviewed. And then because 2.8 and 2.7 doesn't really talk to us so much, we put that into dollars and cents, which is what we care about. Hopefully people care about dollars. They're going to have some cents too. To do the math, and here we are at 1375. So what the total that was collected, this is a credit trade, was 1375. We factor in the transaction costs, like any good person is going to do the math on their overhead on that structure, and we come up the actual credit. This is the most that you can make on a short premium trade when you collect credit. And as you can see here, we do the quick math on turning $1,305, which is the difference here after the costs, into break-even points. So here your break-even is 5.22. As long as you buy back these positions, you collected 522. If you buy them back for less, you make money. And you have to keep monitoring the premium, which you can do 24/7. You can do it on our platform. You can do it in real time on quotes, and you can also do it on a simulation platform that we will make available to you. Intrinsically, on futures value. So we know the range that we want to be covered in. This range is between 1644.78 at the time. So as long as by expiration we're between 1644.78 as a low number and 1905.22 as a high number, as long as at expiration we're between those two numbers, that's our break-even points. So anything higher than this and lower than this, the profits begin, and the actual loss parameter, and you'll notice that this, nobody here is trying to, we want to be realistic with risk and reward so people don't make mistakes. So there is in red, which is how the risk should be listed, the loss is $25 per tick move above 1905.22 and below 1644.78. Somebody thinks this is a pretty comfortable range, then in theory this would be a good trade, but we want to make sure that they are mindful again of the risk level, and then we actually illustrated the range and how a big breakout outside of this range, where although we're hoping to make 1305, or the person putting on this trade, I should say, is hoping to make 1305 or somewhat less if the market starts moving, they should be very mindful that that gain, which is limited but available in a broad range, relatively speaking, of the market, if the market should go against that broad range and expectation intrinsically, as you can see, the losses can be pretty significant. So if somebody says, I can't afford for this market to go to 1525 and lose almost $30,000 intrinsically or more, depending on the premium, then no matter how good this range looks, and no matter how attractive these kinds, the likelihood is that it's going to stay in that range, and you think you're going to make 1305, you always have to be mindful of the risk and make sure that you can tolerate it. If you can't, you either have to not do the trade, or you have to find some covering strategies perhaps that will mitigate your risk. And as we spoke before, you can buy options on the wings of this trade so that you collect less money, but also some of these outsized unlimited risks on rallies would be capped as well. And again, I'm not saying the market's going to go to 2150. It's not my opinion, but this is an objective software, and what you want software to do is do the math. So intrinsically, yes, if the market, for reasons I can't possibly imagine, gets to 2150 in a short time frame, that is the level of risk on this trade. And if somebody cannot tolerate it under any circumstances, then they should not do it. So again, this is a short strangle, limited profit potential, fairly good likelihood of success statistically based on studies by the exchanges and others, but when those things don't work, they can go against you in a significant manner versus a limited profit. Now, do we have a value on these, Roy, as an update so that we can see how these work? Do we have some updated prices on this and see where this market went? Can we get some prices on the 1900 call and the 1650 put?
The 1650 put's trading at about 120.
Okay, 120.
The 1900 call is at 290.
Okay, so as you can see in a market that's kind of bounced around, it's been up and down. So you say on one side we lose on the 280, we're down 10 ticks. Okay, so that's minus 10. But on the 270, where's the market? 120? On the 11650 put, I'm sorry?
120.
Okay, so we're looking at 120. So from 270 to 120, we've got a gain of 150 on one leg, using these hypotheticals, gain of 150 on one leg, loss of 10 on the other, so we'd say it's a net of 140. So what's our tick value? We know what 1.4, our tick value is $250, so it's 1.4 times 250, and then you know how much you picked up. So in this particular case, the trade would be up
About $350.
About $350. You take out your commissions in this particular case, and the person could offset this trade for a trade of somewhere around 280, 290, depending on the actual fills and with a deduction of costs. So again, if your premium break-even is 522, and you can come out at 290 at 430, the difference is what you've gained. Okay, so this is the way you can calculate the tick values, or you can just actually input the new numbers and see how that trade is going on. So here we go with 290.
We have a question regarding this trade, actually.
Okay.
If I have a good profit and expiration is still a ways away, should I take profits or lock them in somehow?
Well, first of all, there's an old saying that I really like. It ain't a profit till it's in your pocket. So if you look at a trade like this, and let's calculate it, and again, this is all hypothetical, although we're trying to work with realistic values. If somebody put on a trade 2 weeks ago, and let's say on a margin of, what would be the margin on this trade based on current margin?
It should be around 6,000, isn't it?
So let's say for argument's sake you have a $6,000 margin, and you make, again, I'm exaggerating to make the math easy in my head, it's $300. One way to do the math is how much am I gaining on a percentage basis against the margin, and is that satisfactory? So somebody could turn and say, I've got $6,000 worth of margin in a given trade, if that's the number. I made $300. That's 5% in 2 weeks.
I'm sorry, I actually made a mistake. That was the E-mini. The full-size contract is actually $24,000. Yeah.
Okay, so let's call it $25,000. So let's say if somebody makes $250, so I'm going to go the other way, that's 1%. 1% in 2 weeks may be satisfactory given the level of risk and the fact that, you know, if you can do that every couple of weeks, you've got results pretty well into double digits. And taking this kind of risk off the table quickly is a good idea in some cases. What are the variables? Let's say you're looking at this trade and you're trying to decide whether to try to eke out the remainder of the premium or whether to just walk away a winner. Well, one thing is that if your outlook is that the markets are quiet and you want to collect a certain amount of money and you've hit your objective, you can just offset. It ain't a profit till it's in your pocket, you leave a little money on the table for the next guy because he's going to be picking up the risk, so to speak, of having this margin trade. On the other hand, if you want to reduce your costs or have time erosion, you can buy back some, you can offset the trade, you can buy covering options, which will now be cheaper and end up with a smaller credit, but also mitigate your risk through the balance of the trade. So number one, is the objective, profit objective, what you had in mind or close to it, number one. Number two, are there any market factors that would cause you to change your volatility outlook? Remember, your outlook here, that volatility is going to go down. If things have changed from this point and you say, well, the volatility is going to go up, then your outlook has changed. You're no longer looking for time decay and falling volatility. So then you might just say, you know what, I'm going to take my 1% over the 2 weeks and walk away a champion, not take a chance on turning a winner into a loser. Finally, to be in this kind of trade, the final factor, so we have profit objective, we have volatility outlook, and finally, the extent to which you monitor positions so that if something major happens quickly that will increase volatility, that you are on the alert or that you have some contingent orders or other arrangements in place to offset. When in doubt, always when in doubt, I think people should walk away with a winner, because unfortunately sometimes you're going to people hold out for that last $4 or $5, so to speak, and end up giving it all back and then some. And that certainly is the case with naked or short options. So I think you have to use your own temperament and always be mindful that when you get risk off the table and you can take a profit, you should think about it very seriously, just as a matter of personal discipline, So any follow-ups on that, or can I move to the next example?
No, please move on.
Okay, so that's the example on the S&P, and again, we did the example here. We did the same example on the E-mini, so the consequences would be the same. Again, this was to demonstrate the type of thing that certain money managers or CTAs do, where they use a small contract, they collect a very small premium, they monitor positions very closely, and when you look at it, you're saying, well, how can these people take such outsized risk for such a very small return? Again, number one, they're watching the markets. They're selective, presumably, in what they do. They don't anticipate rising volatility, in which they could be right or wrong. And mostly when you see this type of trade, where there's a low premium collected, a fair amount of risk, and as well as was in the larger trade, you must think of this, if you will, as being some kind of a private insurance business. And insurance businesses do operate on the premises that they pick away by premium collection. Notice that the wording is the same. You collect premium like an insurance company. You bank the premium. It doesn't seem like much, but the odds are in your favor and it adds up. And once in a while, assuming you're sufficiently funded, like an insurance company should be, then once in a while there will be outsized movements and debits and payouts on claims that individually can amount to much more than the individual premiums collected. But again, in the case of such managers, as in the case of such insurance companies, the calculation is to pick away, to play the odds within a range, but to be prepared for adjustments and for events where a large event, a large incident, means that you have to pay up because you took on certain obligations in exchange for collecting that premium. In this case, the obligations are to be available to sell below a certain number and to buy above a certain number. So your bet, so to speak, is in this range. Your obligation below is very much just like a straight-out sale of a put. You take on the obligation that somebody can assign a position to you in which you have to agree by selling that put that you are willing to commit to a futures position at that level, and likewise when you are selling a call, that you are obligated to take a position at that level against the counterparty which has the right to buy the futures from you at, in this particular case, at the strike prices. So to break down the trade a little further, what you're doing basically is that I'm going now to the short strangle strategy box. And as you can see, every trade consists of its component pieces. When you sell a call here and you sell a put here, it's a combination trade. It's all on the spreadsheet, but you can see them as individual components that we've already discussed and will begin again next week. One is that the person who's buying this call from you has the right to buy futures from you at 1900. And if they go above 1900, then you have the obligation to give them futures at 1900. And likewise, if it goes below 1650, or they exercise the option, you have the obligation to let them have that position at 1650 on the short side. So basically, anything outside of your range, like an insurance company has to pay out on a claim, when the counterparty exercises, you have to be long above 1900 or long at 1900 or short at 1650. Chances are, if the market's in between, then you just keep that premium, just like an insurance company keeps a premium if the condition against which they insured was not met. So as you can see again, these are the two obligations. This is your range, and if you don't understand this trade in its entirety, where you're betting in the middle, another good way to grasp it is to understand what is selling a call, what is selling a put, and in this particular case that you are doing both. The great thing about the option ranger is it does the math for you right away, so you don't have to knock yourself out, and you also see the difference, in this case, between two different contract sizes and two different levels of risk. So as you can see here, not only is the profit potential less on a small contract, the risk, if the market breaks out against you, is also smaller. And we can change these strike prices all the time. In fact, now that we've gone through the E-mini example, let's go ahead and have a look at on the same date, we did a short strangle webinar. Let's have a look at silver. And then we'll maybe open it up to one new example if I have a request. Again, right here, the trade is already input, so we don't have to do it. You will learn how to input these trades yourself. We will put them in for you on a tab, or we can do it together, so that the educational component of our program is fully understood. Again, here we have a short strangle in silver, which means that our outlook on this market is for falling volatility. And again, when you input the strategy, when you input in short strangle, these fields are automatically populated. The short strangle consists of selling a call and selling a put, so that all we need to do is fill in the quantities and the strike prices and the premiums. And for all of those, as I've already showed you, we do have these helpful dialog boxes on how to input them, along with our help in the initial stages when you set up the tabs. So here, this particular outlook is that the market is going to diminish in volatility. It's going to flatten out and end up somewhere between $25 in silver and $17 in silver. Again, this was initially, we looked at it initially on the 13th, so it's a couple of weeks ago. Gold has really shown signs of excitement, and as I see here, we have May silver is at 21.31, and let's look at the trade the way it was set up then, and then we'll just, for curiosity, see where it is. Again, this is not a recommended trade, whether it made money or lost money. It's not a real-time example. It's an illustration. So again, here we're selling one silver call, meaning that we are betting the market's going to stay below 25, because otherwise we're going to have to commit to selling it to somebody at 25, and we're also going to have to, we have a commitment to somebody else here that we're betting if it's going to be above 17, so it's going to be between 17 and 25. The closer to the middle, the better, because obviously if these strike prices are far away, time erosion is going to be a factor, and that's what we're looking for in this trade. So the net premium collected here between the call and the put, they're both in at the same price of 5.25, was 10.50. Here we had a round-turn commission of 45 as a default, and so the net credit after that set of costs would be 960. Again, when you collect premium exclusively, your maximum profit is the amount that you collected. You can't make more. That is in exchange. The reason a person settles for a limited profit potential is because they are getting a big range in which, or at least in their opinion, they're getting a big range from 25 to 17. So they're saying, well, if it's staying in that range, I can get 960. I'm pretty comfortable. It's not going either way. So then we translate the premium, the dollar amount, back into premium, so that when you get quotes online or from your broker on your platform, you know at what number you are making money. So you need to really, since you collected 19.2 cents, whatever you can pay less than that to get out of it is your profit. So if you collected 19.2 cents, but you can get out of the position at 9.2. I just made the math easy for myself for a reason. So let's say the premium is quoting at 9.2. And so for 19 point, what do you say? I picked up 10 points, or 10. What are 10 points here? You see you see that it's 5,000 troy ounces. So you pick up 10 cents times, which is 0.1 times 5,000, and you would know that your net was $500. So you can come out, you collected 960, you only have to give back 460, and you can keep 500 of your original dollars. You may make a choice to think that that's reasonable, either because you like the return or because you think volatility might go up. So you keep tracking the premium to see if you're coming out. Now, let's say, for instance, you stop liking silver, and the premium is at 29.2, which means that the market started breaking out, probably either closer to 25 or closer to 17. There's a lot of action. Premiums are going up. You can turn around and say, you know what, I got in for 19.2. I collected 19.2. I'm going to have to pay 29.2 to get out, or some such number. Then you collected 960. You have to pay 500 more to get out, so you would have a loss of $500 if you had to pay 29.2 but only collected 9.2. Again, that's 10 cents times the contract value, and you have the number here, or you can actually input the values. On the futures for intrinsic value, because you do collect premium, your futures break-even point is actually lower than your strike price. The strike price you sold was 17, but because you collected 19.2 cents, your break-even is at 17 minus what you collected. And also on the upside, you have that 19.2 cent cushion on a rally, so your break-even intrinsically on futures is either 1680.8 on the drop or 2519.2 on a rally. Again, because this is a margin trade, it's a short strangle, you're selling premium. The most prominent thing you see on these pages, because this is not about telling people to do trades, it's about measuring risk and reward. In bright red, we see here that there's a risk of $25 per tick move above 2519.2 or below 1680. Or the way I like to do the math is just to say $50 per penny. So let's see because it's 5,000 ounces, and then again we have the review of the contract size, the tick values, and so on. And finally, let's look at the trade at that time. Most it can make 960. Obviously, it was at that time, according to this opinion, a wide range, if that's the opinion one adopts. However, anybody who thinks that silver could suddenly and explosively make an upside move, let's say to 29 cents, big move, but I guess, just have to think, is that the kind of thing that can happen? That would be a real big move with rising volatility. That is not what an option writer or a short premium player wants to see happen. And as you can see, as margin trades go, the numbers get pretty adverse on an explosive, sudden move up or down. So again, for people that cannot tolerate this type of a margin risk, no matter how strongly you feel about this range as being a range that will hold, you have to be very mindful of the unexpected, of black swan events that might take you into some of these areas. And if those areas are areas that you cannot tolerate as to risk, then you just have to put these trades aside. Or, again, you can look at a covering strategy where perhaps you say, well, I'm going to, instead of collecting 960, I'm going to collect less, but I'm going to reinsure my risk perhaps by buying a 14 put, by buying a 28 call, or whatever the numbers might be, and see if the math still adds up. Those trades would be iron condors. There are iron condors that you can do to get coverage for that, and they are illustrated in our strategy gallery. There are essentially ways of collecting less money, but in exchange for collecting less money and having a big range, you can pay premium and reduce the unlimited risk on the edges. Remember, usually when you add reward, you add risk, and if you reduce risk, there's some sort of a cost or some sort of a trade-off. So here you have to be very confident of a tightening range. And let's go ahead and go to one more example, and let's try to find a volatile market and show everybody how to input a trade. I'm going to do a reset, and do we have a recommended market? Have you received any questions, Roy? I know that we got the S&P question. We handled the silver question earlier. Do we have a recommended market for running an example?
Well, sugar's been very choppy lately.
Let's see how high the premiums are. Okay, if the premiums are high and we think the market's going to flatten out, let's have a look at sugar. As you can see, it's 112,000 pounds, so every penny move is $1,120. So the trading strategy, and again, this is, we don't know, this is for somebody who says, I don't know where this thing is going, I'm not sure what's going to happen, but I think it's going to quiet down, and who knows where it's going. So again, let's go ahead and make this up. Let's expand the rows, because in a unlimited risk trade, you want to see things all the way out to the edges. As you see, the dialog box already opened, selling a call, selling the put, so we know the composition of the trade in advance. All we have to put in the quality. When I click on strike, the help menu comes up so that we can see how to input the strike price correctly. So let's go ahead and see where the market is right now. Let's have a look at some May options, shall we? So let's say, what is the 19 cent call?
The 19-cent call settled at 45 points.
Okay.
The market's currently at 1807.
So that settled at 45 points, and again, we'll see how to input the premium here. 2 cents is like this. So it's really a 0.45, and if you have questions, remember you can always hit the Learn More tab or have us help you with it. We're also going to have a directory of how to input tick values and demo videos on how to input values. Now again, let's say if we have about 1 cent away on top, let's put about 1 cent away on the bottom. So we're looking at a range between 19 and 17 in this case. How much is the 17 put?
It settled at 0.33.
Okay, so that's 0.33, which is 1/3 of a penny. Okay, let's see what we have here. Everything seems okay, but when we calculate, we'll know if we missed anything. Again, if I had forgotten to select a number of output rows or input the cost or any of these items, we would get an error message that would tell us what to put in. Let's have a look at this trade. Again, this trade is betting that the market is going to stay below 19 and above 17. So we're looking for a range of 17 to 19. You'd have to look at a chart or whatever opinion you have to say that volatility is going to go down and the prices will stay in this range. Closer to the middle, the better. We collect $504 on the call, and that's just basically multiplying 0.45 by the tick value, which is, and likewise on the put, it's 0.33, which gets translated right into dollars, which is the denominator you want. You subtract, in this case, a default rate of 45 around turn times 2. So the net trade collects 784. And as you will see, the maximum profit that you can make, as in all the others, is 784. When you sell premium, whether it's a call by itself, a put by itself, or a short strangle, the most you can make on any pure selling premium transaction is the amount of net premium that you collected, which is the premium minus your costs, give you your net. So now we take that $784 and translate it back into sugar points, because it's a 112,000 pound contract. So instead of you sitting there with a calculator, and many people kind of lose track of what they're doing, trying to figure out the tick values, now we know it's 16.3. Now we really want the position. Hold on a second. We collected 784, so we really want the position on premium. It comes out to 0.7, so that's the premium that you look for. If you can pay less to get out, you're making money. If you have to pay more than 0.7, then you're losing money. So this is your break-even on premium, and premium is what we monitor throughout the trade. Intrinsically, on in-the-money value, when you factor in the premium that we've collected, the low break-even at expiration is actually at 16.3, and the high break-even is at 19.7. So all we're doing here is subtracting our, using the cushion of the 0.7 that we collected against the put that we sold intrinsically, and using the cushion of what we collected against the call that we sold. The reason we can use the full premium is because, again, at expiration, the market can't possibly be above 16.3 and below can be below 16.3 and above 19.7 at the same time. These are mutually exclusive positions. So either we're in the middle and we keep the whole premium, or we have to exceed these points in either direction before the premium that we collected in total, including from the excluded side, because they're mutually exclusive, gets overcome. So now here again we have a reminder, it's sugar, we have a contract size, a tick value, every point is 1120, and one option unit, which is a 1 cent move, it's $1,120. And now we look at the trade. We look at our sweet spot between 19.6 between the 19.6 and where we are, and then more importantly, you start seeing the risk. If you look at this trade, you say, well, 784 is pretty good, and you have strong reason to believe that the market's not going to break under, let's say, 17, as you do here. That's a good trade. You have a little bit of a cushion intrinsically, and then the naked option begins to go against you as prices drop. Again, if somebody has a reason to think that they're doing this trade, but there's a scenario that this market can drop to 13 cents or 12.5 cents or 14.5 cents, that's rising volatility. It's a big breakout. That would mean this is not the trade for you. Likewise, if there's any scenario under which you can envision a very big upside call, as you can see here, an upside move, that option becomes naked and marginable. So you'd have to be very mindful of putting on either this type of trade if you think there's going to be a massive breakout with rising volatility in either direction. And then you would have to consider some kind of risk mitigation strategy or move on to something else. I think that actually in the case of sugar, which had extremely low volatility for a sustained period of time, if the volatility comes off, and I think it's very difficult to guess on direction because this is a weather market and there are production issues and weather issues, but should some of those resolve one way or the other and volatility comes down, at least speaking in terms of the recent implied volatility of sugar, if there is an expectation of diminishing volatility, this would be an interesting play. Given, again, for somebody, only if somebody's expecting diminished volatility, a narrowing range, and no major breakout in any direction. On the other hand, if you think that the volatility is going to stay the same and you want to take advantage of these higher premiums and you do have direction, then you would have to go back to the strategy gallery and come up with an alternative strategy that uses your volatility outlook for direction. In this particular case, there is no direction. The only thing we have is an expectation of diminishing volatility. If you do have a direction with an expectation of diminishing volatility, then that, again, is an entirely different trade as we would find in the strategy gallery. Any other questions? Okay, I think that's it for now. If you'd like. Okay, if anybody has any, again, I want to remind everybody, be sure to set up with your own login, your own username and password, so that you can visit your own unique web page and have your trades and trade tabs set up in accordance with where you are in terms of your learning, and also in accordance with the types of things that you think are useful for you to learn about for your future trading. So be sure to set up your own tab and make sure that the tab is consistent with where you are, both in terms of your level of expertise and also in terms of the types of things that are practical and useful for you to learn. So we look forward to working with you in these webinars, but it's even more important that we all work together one-on-one so that everybody's particular level is addressed accordingly. So again, we're going to do hot markets tomorrow at 11 in the morning. In the meantime, if you have any questions, don't hesitate to send them to us or to contact us. And also be sure to check up our existing tools in the demo video and resource sections. Have a super afternoon, and thanks again for your participation.